moving on from that, let's turn back to the US, and we had a hot inflation number overnight in the US. Jonathan, maybe you can talk us through that and what you think, or how you think that's going to impact the outlook for interest rates in the US.
Yeah, sure. It was a hot number, Eugene. You're absolutely right to describe it as hot. You could even say hot, hot, hot. I'm not sure if that's a song or not. I'm showing my age now. If it is a song, it's probably from the 60s or the 70s. Let's just run the numbers very quickly. We won't get too much into the kind of plumbing of the report, but the number at the headline level was hot, as you say, month on month up 0.5% month on month. That's for the month of January. I'm going to look at my notes because I've written pages of notes on that CPI release. I think it was the highest monthly increase since August 2023. Wait for a minute. I got it. Yes, the highest month-to-month increase, up 0.5%, highest since August 2023. So that's kind of interesting. And then obviously excluding food and energy, we were up a 0.4%, actually nearly rounded to 0.5%. Now that would have set a cat amongst the pigeons. But the actual core CPI, ex food and energy, obviously up 0.4%. So just give you the year-on-year numbers. So annual CPI at a headline level is now 3%, and the core CPI year-on-year is at 3.3%. The previous year-on-year for the prior month was 3.1%. So we're seeing this acceleration. Not only is inflation remaining sticky in the United States, we're actually seeing a little bit of an acceleration in the year-on-year rate. Now, when you break the number down, I mean, obviously everyone's talking about eggs. No one's having omelets or scrambled eggs anymore in the United States. So the highlight that everyone's talking about, eggs in the month of January rose 15.2%. Okay. And on a year-on-year basis have risen 53%. Okay, that's the comical part of the report. The unfunny side of the report is that when you start looking at what the Fed told us, what Powell told us were some of the main things that they look at, all of the Fed's preferred kind of subcategories were all very, very misbehaved. So, for example, so-called super core service inflation, which strips out housing, because of course you might remember, Eugene, years ago I got a bee in my bonnet about owner's equivalent rent, which obviously is the largest component part of CPI, and that's what led to that surge in inflation, was that rent inflation surged. But super core service inflation, which excludes rents, excludes shelter, rose on the month 0.8%, on the month. Now just annualize that number. I mean, it starts getting crazy. The other dynamic, which is interesting to note, one of the reasons why we saw such a pronounced deceleration in the rate of inflation from 22 peak, down through the end of 23 through 24, was of course that goods prices went into deflation. We had outright deflation in the month-to-month rate of change in goods prices. We're now seeing an acceleration in the rate of goods price inflation. Now, you've got a problem if service-based inflation remains sticky. Yes, it came down, but it's not falling anymore and is slightly rising, at the same time accompanied by rising goods prices. That's a double whammy. And the Fed didn't have that on their radar. So all in all, not a friendly report. Obviously, the bond market reacted commensurately with a 9-10 basis point spike, pretty much along the curve, 10s up 10 basis points. We also had a 10-year US Treasury auction overnight, and we actually had the highest coupon, 4.625, 4 5/8 coupon, highest coupon on the 10-year note since 2007. Now, it's not the highest yields, because obviously in October 23, we had that real spike up to 5%. That's a yield to maturity. Now, these are the actual coupon rates. And because the auction came just after CPI and we had that big sell-off in bond prices, 9-10 basis point rise in yields, you got a shift higher at the auction on the settlement yield, which was, so the coupon came out at 4.625, high since 2007. So that was kind of interesting. Bottom line is the Fed will not be happy with the CPI number. Now, I don't want to dwell in too much into the so-called seasonal adjustment factors. Okay. Every month is seasonally adjusted. And what has happened in the last 4 years, that the January number has been somewhat higher than the rest because a lot of businesses, particularly in the service sector, tend to change their pricing at the beginning of the year.
Right.
Therefore, in the last 4 years, in a period of much higher inflation, service-based companies have generally used the January repricing as an opportunity and an excuse to put in a little bit extra price for the start of the year. And the seasonal adjustment factor the BLS uses hasn't yet sufficiently seasonally adjusted for this new post-COVID inflation world. So there's some saying, it is...
Don't worry about it because it's January.
Because of the January... Yeah, correct. Because of the January effect. So, but bottom line is the market is now pricing just one rate cut by the Fed. Lots of commentary and conversation around the neutral rate. We've spoken about that on our investment committee. We've spoken about this kind of realization that inflation is stubborn, sticky, and that the Fed is basically took a lot of those rate cuts off the table. And the other thing we've spoken a lot about, Eugene, within our team, is, of course, that we've seen 100 basis points of cuts by the Fed, that first one in September being 50 basis points, followed by 2 consecutive quarter point cuts, making 100 basis points, 1%. And at the same time, the 10-year note yield has risen 100 basis points. That has never happened before, apart from a very brief moment in the early 80s. We've had conversations about that, you and I, before. So it's a really interesting environment. And then, Eugene, we have to throw in the mix the tariff conversation. I think it was overnight or maybe the day before, Dr. Larry Summers, obviously former US Treasury Secretary and very influential, he came out, I think overnight, saying that he's very concerned that with tariffs coming down the pipeline, at a time when unemployment's at 4%, average hourly earnings running at an annual rate of 4.1%, at a time when inflation looks like it's kind of sticky and stubborn, Larry Summers is saying, watch out. We could get a bit of an acceleration here in the inflation rate.
Because if we agree that Trump net is going to be inflationary with his tariffs and other bits and pieces, that wouldn't have flown into any numbers that come out yet, right? So that's perhaps something you might see later in the year. So, not a good start to the year. Can I just ask, those numbers that you mentioned earlier, how far out were they from what was expected?
Yeah, okay. So the headline month-on-month increase of 0.5%, the market was looking for 0.3%.
Oh, that's a big difference.
It is quite a big difference. And as I said, the core CPI almost rounded to 0.5. I think it came out at 0.445. If it had come out at 0.45, as you know how rounding happens, they round up to the next decimal. So it was touch and go, and that would have really spooked the market because that would have been another big miss. But anyway, bottom line is, yes, tonight we've got PPI. The fun never stops when it comes to US inflation. I'm not staying up through the night for this one. Producer prices tonight, and that gives us a better insight into the so-called PCE number, which is the preferred inflation indicator at the Fed.
Sure, you'll be up early to see that, Jonathan. So not only was a hot inflation number, but it was an unexpected.
That's right.
Hot inflation number, which tends to spook the market more. All right, cool. So we only 6 months ago we were talking 4, 5 rate cuts, and when we last spoke, I think the projection was 2. Now we're talking 1. Where are we going to be in 3 months' time? So watch this space.